Okay, good morning. This is the Orange County IDA's PPP follow-up webinar. So we're just going to give everybody a few moments to roll in, and then we will kick it off. Once again, as everybody starts to log in, just wishing everybody a good morning. We're going to wait just a moment while everybody rolls in, and then we'll start the presentation. All right. So I think we'll go ahead and get started just to be respectful of everybody's time. So good morning again, everyone. Welcome to the Orange County IDA's webinar focused on updates on the Payroll Protection Program and guidance for loan forgiveness. I'm Laurie Villasuso. I'm the CEO of the Orange County IDA and the Accelerator. This is the 10th in a series of webinars sponsored by the Orange County IDA to help Orange County businesses cope with COVID-19. We've covered a variety of business topics on these webinars, from the Payroll Protection Program to re-envisioning your business in the new normal and opening procedures as our economy starts up again after the New York On Pause program. Today, we're going to continue the discussion of the Payroll Protection Program. We want to give you as much information as possible on updates to the program and what you'll need to be sure your loan is forgiven. Again, a lot of changes have come in the past couple of weeks, so we want to make sure we give you the most up-to-date information we can. We're fortunate to have with us once again Joshua Steele, a partner with the law firm at Harris Beach. He's with us to help guide us through this evolving process. Please remember that you can ask questions through the Q&A dialog box on your screen. We'll get to as many as we can today at the conclusion of the presentation, and those we can't get to, we'll follow up with after the webinar. Just so you know, we have another webinar planned for next Thursday, June 25th at 10 o'clock. That one will be focused on financial management to help your business recover from the pandemic and remain strong. Miriam Bouchard from the Small Business Association will be with us then. Now, on to today's speaker. Josh Steele, a partner at the law firm of Harris Beach, represents employers in administrative proceedings before the New York State Division of Human Rights, the Equal Employment Opportunity Commission, and the Unemployment Insurance Appeal Board. Most relevant to today's discussion, though, Josh has become one of Harris Beach's experts on the Payroll Protection Program, and we're so pleased he could join us today to share his information. So with that, Josh, I'll turn it over to you.
Thank you very much. I want to say prior to starting that we are at an interesting time with respect to PPP forgiveness, given the legislation that came out in the beginning of June, and then we received some new interim final rules, updated applications and updated instructions yesterday. So everything's a little up in the air. And for those of you that have attended previous webinars on forgiveness, there are a couple of slides that are going to be a little repetitive, but just note that there are actually some minor changes in there. I'll point them out when we get to them, but things have changed a little bit, even on the stuff that we already reviewed and stuff that we thought we already knew. So the first couple of slides, I'm just going to give a brief background for individuals that have not attended a lot of these before on forgiveness, and then we'll kind of go into the changes through the Flexibility Act, and then kind of address the new changes in the application. So just for background, the great thing about the PPP loan is this element of forgiveness. Under this loan, borrowers are eligible for forgiveness amount in an amount that will equal the sum of the costs incurred during the covered period. That's in quotes, we'll talk about that. That covered period generally starts on the day you receive the PPP loan. There's some exceptions there too, but the money that's spent on the following categories: payroll costs, interest on any covered mortgage obligation, covered business, rent, lease, or obligations for either personal property or real property, and then covered utility payments. And the examples they give there are electricity, gas, water, transportation, telephone, and internet access. The big rule prior to the Flexibility Act, the PPP-FA, was that 75% of the forgiveness amount must consist of payroll costs. We'll see now that that's changed. So we can go on to the next slide. So the big question is what's included in payroll costs. And, it's the biggest chunk of our forgiveness by requirement. What goes into it? Wages, salary, paid time off. By the way, bonuses are included in this. Money given to employees for time when they don't actually work. Let's say they're on furlough and you're still paying them. That is also included in here. Subject to per employee caps, limitations on how much forgiveness per each individual employee. We'll discuss that. The PPP changed that as well. What else? Employer contributions for health insurance, not employee contributions, whether pre-tax or post-tax, because that would be included in the wages and salaries element of payroll costs. So that's just employer contributions. Employer contributions to retirement plans, again, excluding any contributions by employees for the same reason. Employer state and local taxes assessed on compensation, but again, not any taxes are withheld from employee earnings. And then with respect to owners, it's any amounts paid to owners, which includes owner employees, self-employed individuals, general partners, capped at either the lower the applicable employee cap or the equivalent of their applicable compensation in 2019. We'll discuss in detail on that too. The PPP brought some changes there as well. And go to the next slide. So the PPP, this was a rather, as far as federal legislation goes, this is rather short. It's pretty significant in terms of the PPP. I'm going to go through all the elements and then we'll kind of discuss what the practical impact of those elements are. Probably the biggest one is this enlargement of the covered period. Under the PPP, the forgiveness was calculated, the total allowable forgiveness was calculated by seeing how much money you spent on those different categories of allowable costs during an 8-week period that commenced on the date you received the loan. It was kind of short term. It was considered, hey, 8 weeks, we're going to allow you forgiveness if you spend it the way we want you to for this 8-week period. Well, that was problematic for a lot of borrowers, a lot of employers, mostly because of the fact that they could not kind of return at that time to normal business operations, normal business activity levels. So they're left with this kind of a lose-lose, which is don't spend the money at all and not get forgiveness, but then you've got it, or you've got to spend the money for basically paying people not to work, which, it's so good for your employees, but generally it's not good to keep your business afloat, especially if you're in a situation where, after the 8-week period is up, you're still going to have some economic distress due to the lockdowns and phased reopenings. So the PPP expanded that covered period where we're calculating forgiveness from 8 to 24 weeks. The rule says that, listen, it's going to end the earlier of either 24 weeks from the date that you received the loan or December 31st, 2020. So meaning if you're someone who gets this loan later in the year, then even if your 24-week period would end sometime in 2021, it doesn't matter, where everything's got to end December 31st, 2020. One rule here, for loans that are made before June 5th, so before the PPP was enacted, borrowers can elect to utilize the original 8-week covered period. So you don't have to use a 24-week period. If you got the loan prior to June 5th, you can still use the 8-week period if you want to. Because the covered period was expanded from 8 to 24 weeks, that cap on the per employee wage salary forgiveness that we discussed, it's expanded. So if you're using 24 weeks, it's increased from the $15,385 cap to $46,154. So that makes sense. It's just the 24-week equivalent of the 8-week limit. And both of these limits are based on an annualized salary of $100,000, which was the kind of maximum employee salary you could use for purposes of calculating your loan amount to kind of get rid of very high earners. Similarly, the cap on owner compensation is also increased. So for owners, prior to the PPP, you were limited to 850 seconds, which is basically saying, listen, what the 8-week equivalent of your 2019 net profit. Now they've increased that to say, all right, we're going to do 2.5 divided by 12 of your 2019 net profit. Where did they come up with this number? Why is it different? Well, because when you're applying for the loan, your limitation was based on 2.5 months of payroll costs. So that's what they're utilizing here for owner compensation. So the owner compensation is less than the employee cap. It's capped at the lesser of 2.5 twelfths of your 2019 profit, or 20,833. Another big element of the PPP was the decrease in the amount of forgiveness that must be attributable to payroll costs. So originally, the PPP didn't have anything in the actual legislation requiring any amount of the forgiveness money to be spent on any particular category. It was, you could spend it on these categories and it's forgivable, but there was no indication that they cared how the money fell within those allowable categories. SBA and Treasury came out with interim final rules and guidance saying, listen, when it comes to forgiveness amount, at least 75% of it has to be to payroll. They were really trying to push employee compensation here as opposed to other expenses. Now, that was difficult for a lot of entities, a lot of borrowers, especially if they were operating at a reduced activity level. So they actually didn't have as many employees. So it was going to be difficult to reach that. And it would have taken a significant cut on their forgiveness. So they've reduced that to 60%. Just by way of background here, this isn't a cliff, meaning if you fail to reach the 60% threshold for payroll costs, it doesn't mean you get zero forgiveness. What it means is that they're going to reduce the amount of forgiveness on the other elements, covered mortgage interest, covered lease payments, covered utilities. They'll reduce that amount of forgiveness until you get to a 60-40 ratio between payroll costs and those other elements. So it's not an all or nothing, which is good. There was a little bit of fear when the PPP first came out because it was written in a manner that indicated that this is a cliff, meaning if you don't reach 60%, you don't qualify for any forgiveness. Luckily, SBA and Treasury issued regulations saying, listen, we don't interpret it that way. That'd be contrary to the purpose of the Flexibility Act by providing zero flexibility. So we're going to continue to treat it this way. So that's one good thing if you can't get 60%. Another thing that's very useful is the extension of the cure deadline. And we'll get into this in a little more detail in terms of actual calculations, but for our point here, the amount of forgiveness that you're entitled to can be reduced based on a reduction in full-time equivalent employee counts during the covered period, or based on a reduction of employee salary or wages that's in excess of 25%. The original PPP said, listen, if you cure those reductions, if you cure the reduction in FTE count or the reduction in employee salary or wages by June 30th, then you're not going to lose forgiveness because of it, basically giving you a period of time to get back up and running. They've now extended that cure deadline to December 31st, 2020. So that's good, especially for industries that are having a hard time coming in. So what else did the PPP include? Well, it actually adopted some of the safe harbors that were previously in the older version of the forgiveness application. So the old application had some safe harbors saying, listen, if you try to rehire employees and you can't rehire them, you can't get them back, we're not going to hold that against you. They codified that. They put that in the law. The other one they put in was something about, the return to pre-COVID-19 business activity levels. So here under the FA, there are two things. One, if you can't rehire individuals who were employed by you on February 15th, 2020, and you were unable to hire similarly qualified employees for that unfilled positions prior to December 31st, 2020, that particular individual won't count against you when determining your FTE reductions. The second thing, which I think is very helpful, especially if you want to think about any industry where the public is coming in as customers and you're now operating under some kind of restriction based on occupancy, is that, listen, if you can't return to your February 15th, 2020 business activity levels due to compliance with, guidance or rules established by, HHS, CDC, or OSHA that are related to, social distancing, sanitation, or any other kind of employee or customer safety requirement related to COVID-19, we're not going to hold the FT reduction against you either. So this is a great example here as a restaurant. You used to be able to have 50 people in at any given time. Now, because of social distancing requirements, you're down to 25 maximum. Well, that means you need fewer staff and employees to service those 25, and they're not going to hold that against you because you have no control over that. Go on to the next one. Other elements for the Flexibility Act, these first two apply to loans that were issued after June 5th. So if you received your loan prior to this, it won't apply to you. But for loans issued after that date, the term of the loan is increased from 2 years to 5 years. And for loans issued after June 5th, the deferral period, the time where payments of principal and interest are deferred, is extended until the date the lender receives the forgiven amount from the SBA. So this basically pushes this date back quite a bit, and it kind of puts the onus on SBA to make the decision. Prior to this, it was just a 6-month deferral from the date of the loan. The problem with that is that you could have submitted your application for forgiveness, and the SBA could then sit on it for 6 months or 9 months in processing, especially if they're overwhelmed. And in the meantime, you would have to start making payments of principal and interest through no fault of your own, even if the majority of it was going to be forgiven. They changed that to say, listen, now you don't have to start paying until you know how much of your loan is not going to be forgiven. So that's good. The one kind of caveat here is that you have to eventually apply for forgiveness. They say that the deferral period for loans issued after June 5th is going to end on the date that is 10 months after the end of the 24-week covered period if you fail to apply for loan forgiveness during that time. So they're basically saying, listen, we're going to give you 10 months after the end of your 24-week period to apply for loan forgiveness. As long as you do that, then the loan will remain in deferred state until the SBA makes a determination on forgiveness. If you fail to make an application for forgiveness in that 10-month period, then it's going to become, the payments will start becoming due at the end of that 10 months. So again, just kind of an incentive to push you to make that application. One other element of the PPP that isn't getting as much attention, but it deals with the payroll tax deferral provisions of the CARES Act. So that's an area where employers can defer the payment of certain payroll taxes for 2020 and then pay them back at the end of 2021, half of the owed taxes, and you pay the other half back by the end of 2022, basically just to improve cash flow with no penalties or interest. Previously, the guidance had indicated that once you were notified that a portion of your PPP loans were going to be forgiven, you couldn't continue to defer that payroll taxes. Now, they say you can continue to defer for 2020 even after you receive loan forgiveness. I'm curious in application how much this will actually come into play because it won't come into play unless we get, basically SBA approval for forgiveness during 2020. And I'm not sure what the delay is going to be on that. It'll be interesting to see in practice whether or not there's a bunch of people that are, getting an extra, 4 or 5 months because of this new rule, but it's on the books now. So go to the next slide. All right, so we talked about the safe harbors for FTE reduction forgiveness. This is kind of the way the rule applies, and this is a really important part of the PPP loan forgiveness. It's probably the most common issue that borrowers are going to run into when they are determining how much of their loan is going to be capable of forgiveness. So under the rules, your total forgiveness amount, and I'll just step back here, your total potential forgiveness amount is the money that you spend on those qualified expenses during your covered period, either 8 or 24 weeks, your election if you had a loan prior to June 5th. So you can choose which period you want. If it's after June 5th, you're stuck with the 24 weeks. So your maximum potential bundle of forgiveness is all of the money you spend on those categories up to the PPP loan amount, right? So that's the cap. That potential forgiveness amount can then be reduced. And the two biggest things are due to an FTE reduction or due to a salary or wage deduction. So that forgiveness amount can be reduced by multiplying the total allowed forgivable amount that we just discussed by the quotient obtained by dividing the average number of FTEs per week during the covered period by either the average number of FTEs per week from February 15, 2019 to 6/30/19, or the average number of FTEs per week from January 1st, 2020 to February 29th, 2020. What does that mean? It basically means you're going to look at your average full-time equivalent employee count during whatever cover period you're subject to and compare it to a baseline period. And if there's a reduction, if the average during the FTE during the covered period is lower, then you could be subject to a reduction, again, with some caveats, with some exceptions. The one new thing here is that previously, and in the law, when they were talking about average FTEs, they were utilizing average FTEs per month, which made no sense. It always seemed it was going to be a week, but the law said per month, and that's what the guidance indicated. They've now changed that and just come out and said, listen, it's per week, which makes more sense. It's really how you would have had to calculate it anyway, but that's a benefit. That's a positive change. If you are a seasonal employer, then you can use as your base period any of the two periods listed above, either one or two, or any consecutive 12-week period that falls between May 1st, 2019 and September 15th, 2019. This is positive. It makes it clear that from a seasonal employer, not all seasonal employers are summer seasonal employers. Not all seasonal employers are spring seasonal employers. They're giving you more flexibility. So if you're seasonal, you can use any one of those three periods. And the real thing here in application, for anybody that suffered an FTE reduction and is worried about it, you're going to go through and do the math for all these base periods and figure out which base period has the lowest full-time equivalent count. And that's the one you're going to use, because that, basically it provides you with an easier level to get back to avoid any kind of disqualification. Here's my easy example, easy math. Assuming the total qualified payments that are capable of forgiveness during the covered period was $100,000, you employed an average of 100 FTEs per week during any one of those base periods. That's your best base period number. Best as in that's your lowest. And then you employed an average of 75 FTEs per week during the covered period. Then in that situation, your total loan forgiveness would be reduced from 100,000 to 75,000. And that's because you divide 75 divided by 100 equals 0.75. That's your ratio. That's your quotient. You multiply it by 100,000 and you get 75,000. So that's how that reduction works. Luckily, there are some good exceptions that we'll get to. We can go to the next slide. So the other area where you can have a reduction is for a wage or salary reduction. One important thing here is that we're looking at this on a per employee basis. We're not talking about looking at overall wages. You're looking at a per individual basis. Your forgiveness will be reduced dollar for dollar for any reduction in an average annual salary or average hourly wage of any employee during that covered period that's in excess of 25%. When compared to that individual's wage from the first quarter of 2020, January through the end of March 2020. So you can reduce average salary, average hourly wage by 25%, but you can't do it more than that unless, and if you do, you might have a reduction in forgiveness. Again, there's a safe harbor here. Important, this is not applicable to any employee that during any single pay period in 2019 received compensation that would have been in excess of $100,000 if annualized. So obviously anybody who's got a salary in 2019 over 100,000, this reduction wouldn't apply. So you could reduce their salary by much more. Also, if somebody kind of has a fluctuating comp, let's say a commissioned salesperson or something like that, as long as one of their pay periods, if you were then to multiply it out by however many pay periods you have in 2019, if that would have exceeded 100,000, then again, this reduction wouldn't apply. The safe harbor for both of these reductions, both the FTE reduction and the employee wage and salary reduction, is something that the PPP did expand, and that is that, listen, any reductions in FTEs or reductions in wages or salary of a particular employee that occurred between February 15th, 2020 and April 26th, 2020 will not reduce the forgiveness amount as long as the reductions in the FTE count of the employee's salary or wage are cured by December 31st, 2020. And again, this is an area where prior to the FA, the Flexibility Act the cure deadline was June 30th. They've now expanded that. One of the questions we're getting a lot is, does that mean that, we have to wait until December 31st? Is that the time they're going to look at to see whether or not we're cured? And that does not appear to be the case. They haven't come right out and said it, but there's enough language in the loan forgiveness application and the regulations and in the instructions for the loan forgiveness application indicating that all you have to do is get back to that level sometime prior to December 31st, meaning that it could be in the middle of summer, it could be the beginning of fall. It's not that you have to be there at December 31st, which is a good thing because it also means that you're not required to wait to submit your application for forgiveness until you know what your December 31st levels are. If they were only looking at that December 31st level, a lot of borrowers couldn't submit their forgiveness application until they got to that date, which is not the outcome that they wanted. So I think that's why they went that route, and I think that's positive. So it looks like you only get to provide evidence that you got back to there during some pay period after your covered period. Go to the next slide. There we go. So yesterday we were issued a revised forgiveness application. Now, in terms of kind of nuts and bolts PPP forgiveness, nothing is more useful than reading the instructions that accompany these revised forgiveness application forms. At the end of this PowerPoint presentation, I include a URL to the Treasury Department PPP website where you can go in and read all this stuff. I think that's useful. But reading these forgiveness applications is probably the most important. We did have this for a while now, we've had this, but now it's been revised slightly. So I'm just going to go through what we know based on this forgiveness application. The first thing, which a lot of people are clamoring for, and this isn't new, this was on the previous application, but it allows employers to utilize an alternative payroll covered period when calculating forgiveness. So I know I said originally the covered period starts on the day you receive the loan. That can be a bit of a hassle. You don't get notice that you're going to receive it. So it's hard to kind of gear up or get employees back on payroll if you did furloughs at that time. So you run the risk of having a week of low wage numbers because, again, you couldn't get people back in quick enough. This says, listen, you can use an alternative period that starts on the first day of the first pay period following the issuance of the PPP loan. And again, if you're prior to June 5th, you can choose 8 or 24 weeks. If it's after June 5th, your covered period is 24 weeks. Another element that is not new is how do we calculate FTEs? The law and the regulations included, full-time equivalents, but there is no definition of full-time equivalents. There was some concern that they were going to utilize the same kind of rules that the Affordable Care Act utilized, which put full-time employee at 30 hours. That isn't the case. What they say is if you want to calculate the FTE for each employee, for each week, you figure out how many average number of hours paid per week, divide by 40, and round to nearest tenth, capped it at 1. So if they work 60 hours, there's still only a 1 for FTE. If they work 20 hours, they're 0.5 FTE for that week. The simplified method, which will be useful for some employers, it assigns a 1 for employees that work 40 or more hours per week. That makes sense. And then a 0.5 for employees that work under 40 hours. Now, this wouldn't be useful for employers that have a bunch of 10 or 15 hour a week employees because it'd actually be rounding up their FTE count. But if employers have a bunch of 25, 30, 32 hour per week employees, it would allow you to reduce that 0.5 FTE in your base period by using 0.5 as opposed to, for example, 0.75 for somebody who worked 30 hours. Again, what I would suggest is if you have questions or concerns about this, that you go through and start running the process and figure out what works best for you before you submit that application. The other thing we kind of discussed already is the full-time equivalent count reduction exception. So the full-time equivalent count will not be reduced by employees that fall in these categories. They were furloughed and then they turned down a written offer to return to work and they couldn't be replaced by a similarly qualified candidate by the end of 2020. Or if they're terminated for cause, they voluntarily resigned, or they voluntarily requested a reduction in hours, or rejected an offer to restore any reduction. So that it's not just a voluntary request. It's also, hey, I need you to go down to 20 hours a week because, you know, things are tight and we don't have the customers or we don't have the clients. And then now you're asking them to come back to 40 and they say, no, I'd like to stay at 20. That's not going to count against you. It's out of your control. The big rule here is that in order for these FTEs not to count, they can't be replaced. So if you're in a situation where you're still in your covered period and you've got some people that refuse to come back, you might want to hold off on replacing them if possible until the end of the covered period, just so that you don't have weeks of zeros, you know, that gap time, there'd be weeks of zeros in between the replacement, the time you lost your employee and the time you hired a replacement. Just something to keep in mind. We can go on to the next one. So another element that was included in the original forgiveness application, which is still there, is that the payroll costs include pay for work performed during the last pay period that falls within your covered period, as long as those employees are paid for that work on or before the next regular payroll date. This basically means that when we're calculating, you know, what payroll costs are, it's not just the money that goes out the door during the covered period, but it's also money that goes out the door due to normal payroll scheduling that's accrued during the covered period, but it actually goes out the door, let's say the week or, you know, 7 or 8 days or 10 days after the end of the covered period. That's good. It probably doesn't matter as much now that we're at 24 weeks, if we're using 24 weeks, because we've got much more time to make sure we utilize the payroll costs that we need to for forgiveness. But if you're going to use the 8-week period, this is helpful. It basically can allow you to get an extra week of covered expenses in that covered period. The FT reduction safe harbor. You know, we talked about the reduction safe harbor, and we talked about comparing your FTE count during that cover period in comparison to some base periods. Well, there's a bit of an issue there. Let's just say, you know, in your previous base period, you know, you had either, you know, another entity, or you had much higher employment levels, you were having a particular boom, and let's say you had a reduction, you know, prior to February 15th that had nothing to do with COVID-19. But so your base period numbers are artificially high, and you couldn't get back to that number even if COVID-19 never happened. There's some other reason that would put you in a difficult situation, but for this safe harbor reductions. They say, listen, if your FTE count for the pay period of 2/15/20 is higher than the average FTE count during the covered period due to reductions that occurred between February 15th and April 26th, and your FTE count is subsequently restored to that February 15th, 20 level prior to 12/31/20, then you're not going to have a reduction. And in this situation, they don't go back and compare it to a base period. Here, all you're looking at is February 15th, 2020 levels, then levels during the covered period, and then whether you get back to February 15th, 2020 levels, you're not going to be compared to that prior period, which again is useful for anybody that had already had a decrease in employment prior to February 15th. It's a useful element. It also makes the math a little simpler. We can go to the next slide. So this is one of the big areas that are under the PPP. We've got a new easy PPP forgiveness application. The regular application has a bunch of complicated math, right? You have to go through and calculate what your FTE count is for every single employee, figure out, you know, what the average is, do a lot of math, fill out a lot of work about, you know, like we discussed, what your FTE base period was, what it was during the covered period, whether you got back there. It's pretty complicated, especially if you're not in a situation where you had any of those changes. So they have now issued an easy PPP forgiveness application. It is much easier, but in order to use this, you have to fall within one of these three categories. The first is kind of easy and it makes sense. The borrower is a self-employed individual, independent contractor, or sole proprietor that had no employees at the time of loan application, and importantly, when they filled out the PPP, had no employee salaries reported in that PPP application. In other words, their loan amount did not rely on anyone's earnings except for their own. If you fall in this category, you can use this easy forgiveness application. It's much easier. Second category that can use this. During the covered period, you either didn't reduce your FTE count subject to the exceptions for the situations we discussed, like someone's request to furlough, voluntary termination, somebody's furloughed but refuses an offer to come back. Those things don't count. So if you're in that situation, you can still use this easy application. And they didn't reduce average salary or wage of any employee by more than 25%. So basically here you're saying, listen, yeah, I don't need to use the complicated information. I didn't have an FTE reduction, so I don't have to do all the calculations about proving that I'm back to normal levels or something along those lines, or any salary or wage levels that were reduced. It doesn't apply to me. Shouldn't have to go through all the work of calculating that and proving that. I can fill out this application. It's a lot easier. The third category that can use this is that people that during the covered period did not reduce the average salary or hourly wage for any employee by more than 25% and was unable to operate at pre-COVID-19 levels due to HHS, OSHA, CDC, COVID-19 related guidance. This goes back to that element like, a restaurant, for example, or a company that has to do social distancing on a factory floor, something along those lines. In this situation, if you did have an FTE reduction, but it wasn't your fault and it wasn't something you could cure because of those rules, you can utilize this, and it's a lot easier and a lot quicker of a process. We can go to the next slide. Here's the area I discussed, this Treasury PPP website. I think it's more useful than the SBA website. I think it's better organized. It's got everything on there that you could want, probably more than you could want in terms of PPP. The big thing to keep in mind is that it's updated regularly, both in terms of adding new documents and in terms of revising existing documents. I think at the last conversation we had when we had just received the loan forgiveness application, I probably indicated that it's subject to change because it always does. The actual application for the PPP loan itself went through several versions, and now they have changed the PPP forgiveness application, and it's likely that they'll do it again at some point. So it's something to kind of monitor and keep an eye on when you're going forward. You want to be sure that you're not filling out or utilizing an old application. And one other element I'll talk about on forgiveness application I think is important is that the initial gatekeeper for forgiveness application is going to be your bank, your lender. What that means is that you need the bank to be on board with your calculation, your numbers. I'm sure a lot of you experienced during the application process, your bank was asking for things that you heard other banks weren't asking for, or your bank was making determinations about what could be included in the loan amount that differed from what either your understanding of the law or what you were hearing other banks were kind of including in the loan amount in terms of payroll costs. This was very common. I worked with a lot of clients that worked with a lot of different banks, and almost every single one of them had a different experience if they were using different banks, and also they had different experiences if they were using the same bank but a week or two apart as everything was developing. What I told them at the time was, yeah, I think your interpretation is right, but if the bank is not willing to sign off on your application for the loan, then it doesn't matter. They're only going to sign off what they're comfortable with. Your options are to kind of act. We can push back and provide some statutory or regulatory language to support our position, but at the end of the day, if the bank doesn't agree to sign off, then you're not going to get the loan. The same thing applies here with forgiveness. We submit these applications. The banks are going to be gatekeepers with respect to determining the potential or the estimated forgivable amount. So we need them to be on board. If they're kind of differing from you, maybe you're right, maybe they're wrong, but at the end of the day, you want the application to go through. I think one good thing here is that we've got more time. There's not a huge rush on forgiveness. So I think it's likely that there's going to be less kind of kinks in the process when we finally get around to requesting forgiveness, which is a positive thing. So hopefully everyone's on the same page. But it's just I'll recommend that you continue to work with banks, maintain that relationship, have the discussions, and make sure you're giving them what they need. That's especially true in terms of documentation. The PPP forgiveness application instructions include a list of the documentation required. your bank might require different documentation. It might require more documentation. Generally speaking, it makes sense to give them what you can if they're asking for it, just to make things easier. Another element that I'll bring up is after the triple PFA, we're getting an awful lot of questions about, well, hey, listen, I got my loan, May 5th. Should I use the 8-week period? Should I use the 24-week period? What should I do? I think that depends entirely on whether or not you can maximize and get full forgiveness during the 8-week period. If you can, then you should use the 8-week period. There's no issue to use it, reason to use a 24-week period that I can think of. I wouldn't necessarily submit for forgiveness immediately, but you are subject to that deferral period ending 6 months after the issuance of the loan, so you can't wait too long. But if you're going to use that 8-week period, again, if you can maximize your forgiveness, great. No reason to use a 24-week period as of right now. If you're in a situation where you could not utilize enough money to reach full forgiveness during the 8-week period, well, then it makes sense for you to use a 24-week period under most circumstances. There are some areas where it might not. So for example, when you're selecting 8-week and 24-week period, that doesn't just apply to the money that you spend and what's included in that. You're not just looking at the money spent during that period. Also, things like the FTE reduction, that will look at the full 24-week period if you select that, as opposed to the 8-week period. So there might be a situation where maybe due to seasonal demands, maybe due to kind of a slowdown, your 24-week full-time equivalent count is going to be lower than what it was during the 8-week full-time equivalent account, because you don't have the triple P money to keep on paying them their salary and wages for the full 24 weeks. So in that situation, it might actually be better to do the 8-week, even if you couldn't quite get full forgiveness, because you're going to do better off than you would if you were doing the FTE count for the full 24 weeks and you end up having a severe loss of forgiveness due to that reduction. So there's nothing at this point in time that prevents us from doing the math on both of these periods and figuring out what it is. And if you could do the math and fill out an application for 8 weeks and result to 100% forgiveness, great. If you can't, then maybe you wait until the end of 24 weeks, do the math on that and figure out what the forgiveness amount is and see which is better. In terms of selecting the period in the application, you're actually putting in what your covered period dates are. So that's something that you do. You've got the option to do that. There's nothing preventing you from doing either one. Again, do the math, figure out what works better for you and your company. You can go to the next slide. So these are some questions that we received prior to this, and I know that we probably received some during this. So I'm going to go through these, answer these, and then I'll turn it over to our hosts, and they'll moderate some additional questions. So when must we submit the forgiveness application? This goes back, we kind of discussed it. If it's after June 5th, you have to submit it within, if your loan is processed, if your loan is issued after June 5th, you have to submit the application within 10 months of the end of your 24-week covered period in order to avoid having payments and interest due and accrued. If you're prior to June 5th, then there is no deadline, but the real issue there is that your deferment period is going to end after 6 months. So you might want to submit prior to that date so that you're not in a situation where you're making payments of interest and principal on a loan that you think is going to be largely forgiven. But so no deadline. Another thing I'll just bring up too, this is a good point, that the issue with respect to the deferral period and the term, but the deferral period I think is more important in the loan in the triple PFA, and it being expanded, due to that act for any loan issued after that date. I would suggest that, and the law itself says this, I would suggest that if you were a loan that was prior to June 5th, it might make sense to talk to your bank and see if there's any way that you can renegotiate the terms of your triple P loan to kind of adopt those PPP FA standards in your loan document. The banks are under no obligation to do so under the law, but they suggest that you do that. I haven't heard any banks voluntarily doing that, but it's just something to keep in mind that it's an option and you should do that. Another thing you should do is look at your original loan documents and see if there's anything in there that basically mandate a change to the terms of the loan in the event legislation is passed altering the triple P. That might be an opportunity to at least reopen or put pressure and say, listen, the documents say that it's subject to changes in the law changed. So we should incorporate this as well. I think that's useful, not so much with the term, assuming that you're going to have mostly forgiveness, but with a deferral period, because it gives you more time to not have to worry about making payments of principal and interest. If our loan was issued before June 5th, 2020, which application do we use? The forgiveness application, whether you use the standard or the easy, depends on whether or not you qualify for any one of those three categories under the easy application that we discussed. So I would go through those, read the instructions for the easy application, see what the three categories are that are allowed to use this, and see if you fit within them. If you fit within any of them, then I suggest that you utilize that one. It's easier. It'll take less time. If you don't, then you have to use the original forgiveness application. Another question here. We received our triple P loan prior to the triple PFA, as the vast majority of people did. Our payroll portion of the funds will be used up at the end of the 8 weeks. Can we wait to submit the forgiveness application and utilize a 24-week option instead of using the remainder of my funds for ongoing utility and rent bills, or am I restricted to the same 8 weeks I use for payroll? I think the one thing here to keep in mind is that you get to, if you're prior to June 5th, you get to select 8 weeks or 24 weeks. If you select whatever period you select, it applies across the board. So if it's 8 weeks for, you want to use 8 weeks for payroll costs, it's also going to include 8 weeks for covered rent, covered utilities, covered mortgage interest, and also the 8 weeks for calculating any FTE, full-time equivalent reductions, or salary deductions. If you choose 24 weeks for calculating the amount of money spent, it has to be across the board for all qualified categories, and then you're using that 24-week period for FTE calculations and wage and salary reduction calculations. So we can't pick and choose, to make that very clear. So I would suggest looking and seeing, listen, which one's going to be better for us. You might not want to wait till the end of the 24-week period, because then your 6-month period would likely be up, or could most likely would be up, and you'd be subject to making payments after you submit an application for forgiveness. But if you can predict what your FTE levels are going to be during that 24-week period, then maybe you decide to go that route. It's not simple, but the best advice is do the math and do the calculations, or work with somebody who can. I've done them a few times. It's a lot, but it's not complicated math. Do the work and see which one works better for you, 8 or 24 weeks, or which one you believe will work better, since you don't have all the information for 24 weeks yet. All right, I'll turn this over to our hosts, and they will, I think, have some additional questions.
Thank you, Josh. Yes, we do. A lot of these questions that are coming in, I think you've touched on them, but I'm going to ask them all anyway, just because I feel like, sometimes there's a little bit of a difference. So some of it will be redundant perhaps, but maybe there will be some finer points that emerge during some of these questions. So
that's fine. Redundant is my middle name, so it works.
Well, I mean, you can't work in labor and laws and SBA stuff without having redundancies, right? So
exactly.
One of them was, if an employee's hourly wage was not reduced, can they enter that amount into step 1 of the wage reduction calculation, or do we need to account for overtime and do a calculation for the whole time period of total wages / hours worked?
Yeah, so when based on everything I've seen, when you're looking at the employee wages, they're looking at your average hourly wage. So I'm not looking at if somebody's getting overtime because, I'm assuming then they've got an hourly equivalent rate. I'm using that rate. It's not the regular rate like under FLSA rules where you're taking total compensation or anything like that. We're looking at what their regular hourly rate is. So, if somebody got paid $10 an hour, but they worked 60 hours, their rate is, their average wage is 10, and I can't do the math, but whatever the total earnings they got for that divided by 60. So it's that average 10. And the good thing is, if you're a New York employer, you probably got documentation already, fingers crossed, due to the Wage Theft Prevention Act, where what their hourly rate is. And also, you've got payroll documents showing what their hourly rate is. So that's the rate that they're indicating we use. Again, this is kind of an important change, actually, because originally the law says average, or said, it said annual salary or wages actually earned during the covered period, and compared it to the wages earned during the first quarter prior to that period. And that's a nightmare because the covered period was 8 weeks, and obviously that's not the same length as as a calendar quarter. So that was a real area of concern. Mm-hmm. But they've now said, no, we're looking at what your average annualized salary is or your average hourly rate is. So we're not looking at money actually earned, we're looking at what their rate is.
Great. Then as a sort of addendum to that one, Joy also asks, if we need to calculate, how do we handle disability?
Yeah, so I would go the same thing. Don't include, we're just looking at what their hourly rate is, or if they're on a salary, what their annual salary is. And to the extent, let's say, take the salary position, to the extent you actually reduce somebody's salary as a result of this, someone who was under $100,000 annual salary, you most likely have that in writing, fingers crossed. If you reduced somebody's hourly rate, you've got that in writing, letting them know you're reducing their hourly rate. So you'll know what their hourly rate is, and you'll know what you have to correct. Obviously, it'll come across on payroll documents as well. The one area where there's a potential issue, theoretically, is there's a lot of clients out there that I have that were some of their employees are based at least in part on commissions. When they got the PPP money, they brought them back and kind of gave them a new wage level to work because commissions were kind of off the table at that point because they weren't earning any because there was no customers. So that will be an interesting area that we don't have guidance on yet in terms of how do you compare their average annual salary when it was some kind of base or draw and commission payments versus maybe you had to switch them to a full salary or a full draw with no commission. That we don't know yet. That'll be an interesting element that hopefully we'll get some guidance on.
The next one from Miriam, she wants to know if the extension includes up to 24 weeks of payroll, or do they need to use 8 weeks of payroll over 24 weeks?
No, so it's 24 weeks basically to spend it. In theory, I guess, or in application, if you're operating at close to full levels, you're going to max out your limit, of the PPP loan itself, because the PPP loan was based on 2.5 months of payroll costs. And obviously at 24 weeks, you're looking at, a little less than 6 months of payroll costs. So if you're back to anything close to, even if you're operating at 50%, your payroll costs will be capped, but you're looking at the entire 24 weeks. You're not picking the best 8 weeks within there. You're looking at the total 24-week period, if that's the manner you choose to go, if your loan was issued prior to June 5th, or if that's the period you have to use if your loan was issued after June 5th. So you're looking at the entire period, again, both in terms of calculations for what was spent and in terms of FTE calculations.
Okay. Yeah, it's very interesting, but it's also kind of mind-numbing. There's just so many little nuances. So the next one is, and I know that this has been gone over, but it's a question that we get every time we talk about PPP, and I think it bears repeating, even though I know you address it during the presentation. But can you just one more time quickly give the definition of an FTE?
Yeah. So a full-time equivalent employee. You're looking at your average FTEs, and you're doing that by looking at each individual employee in a given week and figuring out what their FTE count is for that week, and then adding them all together for that week and then averaging them out for the covered period. So if you are any week, anybody that works 40 hours and more gets a 1. If they work less than 40 hours, you can either decide to give them a 0.5, which is a simplified method. Which, hint, hint, if you've got a bunch of people working 30 hours, then maybe you want to use that. What you really, I guess, want to look at is what helps you in the base period, and does utilizing that method in the base period of calculating also help you in your covered period? I would suggest everyone does this. uses both methods. If you don't use a simplified method, then anybody that works under 40 hours a week, you take their hours divided by 40 and assign them a number. Again, simple math, they work 30 hours a week, they're a 0.75 for that week. And you're going to do that on an individual basis, add all those numbers up, and that's your FTE count for that week. And then you're going to have to do that for every week that falls within the covered period. And if you're not doing an easy application, again, you have to do that calculation for every week that falls during one of your base periods as well to figure out where you're at in terms of any reduction. So it's simple math, but it's onerous, especially if you've got a lot of employees. It's a lot of simple math if you're doing that. I would hope that payroll companies or accounting firms, if you're using accountants, will develop an easy program to do that, to make that easier for you. I would still check. A lot of payroll companies developed similar types of programs for calculating FTE status for ACA, and a lot of them are wrong, at least initially. So I would double check. I wouldn't rely on anything they say, but it might be nice if you get a couple modules in your HRS or your payroll system that allows that to be done a little easier. That'd be something that I'd potentially reach out to your payroll companies about and see if they've got something.
Okay. Elizabeth asks if there's a minimum amount that can be sought.
Sorry, a minimum amount that can be sought for forgiveness?
Correct. Well, you know what? She didn't say. Maybe it's for forgiveness, or maybe it's for the loan itself.
No, so there's no caps. I mean, the loan amount is 2.5. The calculation there generally is based on 2.5 times of your covered payroll expenses. That's the loan amount. That could be low. I guess in theory, if you are a self-employed sole proprietor or something like that, the lowest you could get would be 2.5 twelfths of your 2019 net profit, assuming that net profit was below $100,000. That'd probably be the lowest you could get. I'm not aware of anyone that requested less, given the fact that it was the terms of it were great and they assumed they'd get some forgiveness. I would talk to your bank. If you're looking to apply for a loan smaller than what you're entitled to, I would talk to the bank. I'm sure there's a way that I'm hopeful there's a way that you could do that.
Okay. Elizabeth also asks, and I think this is a good one, is there a list or a link to a list somewhere of what this covers beyond rent and utilities?
Yeah, there's some in the instructions. It's the best we have, I think, is there. If you'd like, after this, I can send this. I could send a couple links to you where there's lists that you can put, that you can send out to people afterwards if that's helpful, or at least to Liz.
Yeah, that would be great. We could put them right on our website, because I'm sure that that's a common refrain that what else does this apply to?
Yeah, absolutely. The one thing is that to kind of keep in mind, the overarching rule is that in terms of everything other than payroll costs, when you're looking at covered rent, covered mortgage interest, covered utilities, one of the big rules is that we're looking at things that are deductible under the pre-existing IRC, IRS rules for tax purposes. So that's one of kind of the big caveats there, is when you're wondering, how, does this qualify? Does that qualify? The question is, listen, would these types of payments be deductible on a Form 1040 Schedule C? Are they business rent payments? Are they business utility payments? So you're looking at pre-existing tax treatment of that, which you can look at prior returns to see how they were treated, and you can talk to your accountants about that as well.
Okay, great. Another question. I used all of my available PPP payroll funds during the 8 weeks, even though I had other options at that point. I would have brought everyone back part-time and saved some of the funds to use during the 24-week new option, and the employees could have continued to collect their reduced unemployment plus their 600 weekly as well. Basically, the gist of this is that this questioner feels that they're being penalized because they utilized the original 8-week program. Do you have any comment or feedback on that, or is there guidance?
The questionnaire is absolutely correct. That is the right way to unfortunately to think about this. If you received a loan and got it before you were in a situation where you actually needed people to come back to work, but you used it because you knew that that's what the rule said about forgiveness, then the Flexibility Act came too late for you. And that's unfortunate. You're not alone. I would say, I would say above 90. I'll say 90% because I can't say it's 100%, but I'm betting it's above 90% of my clients are in a very similar situation, unless they were, in an essential industry that didn't slow down at all. They were all put in a situation where they had to kind of, in order to use the money in the covered period and avoid, huge reductions in the forgiveness amount, they had to pay people when they would have preferred to pay people less, keep them part-time, continue to keep them maybe working, through a New York shared work program, something like that, but they couldn't because they were worried about forgiveness, and their 8 weeks are up and the Flexibility Act came too late for them. That's unfortunate. I don't know that there'll be anything to address that situation. Mm-hmm. Because it's money out the door. They can't go back and change the PPP. So, other than maybe providing some additional flexibility on forgiveness calculation in those situations, I don't see what they can do, but she's absolutely thinking about that in the right way. Anybody that applies for the PPP now or, applied for it in the past couple of weeks and doesn't receive it until after June 5th is going to be in a much better situation in terms of being able to bring their workforce along in a manner in which they see fit.
Yeah, that's unfortunate. So Thomas asks, if you elect to utilize the original 8-week covered period, can the FTE count cure still stay at June 30, or must it extend to December 31st?
Well, they haven't come right out and said this, but what it looks like is, whereas before they were looking at what your FTE count was on June 30th, now what they're looking is they want it back up to February 15th levels prior to December 31st. In one of the applications, this refers to the salary or wage reduction, but I think the same applies to the FTE element. There's a certification or a statement in the application, not the easy one, in the general application, which basically requires employer to say that it was returned to February 15th, 2019 levels by the date of submitting this application. So it didn't say December 31st, basically saying, listen, which made it clear that you could submit this application prior to December 31st, as long as you could say at that point that the levels have been returned. And I think it's very likely, I'm not sure how they couldn't, that the same thing applies to FTE. So it's not so much June 30th is a deadline you continue to use at this point, but it's that you just have to have some pay period prior to December 31st, which shows you return to those levels, and then you can submit the application. That could be June 30th, or it could be second week of July, or theoretically it could be prior to June 30th if you're already up with your 8-week covered period. So that's just something to keep in mind there. They haven't come right out and said that, but it's clear from the documentation that at least at this point, that's what they're intending to do. So it's not, theoretically you could still use June 30th, or you can use December 31st, or any date in between there where you get back to the levels that you need to get to, which is a real benefit, especially for people that have fluctuating work weeks or are worried about a second wave, and they're not sure if they can maintain their FTE levels through December 31st, depending on business. So that's a real benefit to borrowers when they're submitting the application.
Yeah, I think this might actually dovetail a little bit into that. So this question is, if I do not use all of my funds within the 8-week covered period, but I do in 12 weeks, can I apply for forgiveness at the end of 12 weeks and lock in my FTE at that point and not wait until 12/31/20? If the business doesn't rebound without the PPP money, we may not be able to continue to pay staff through 12/31, and our FTE could be much lower by that date.
Yeah, that's the concern. And so we can't do 12. We can do 8 or 24. Mm-hmm. And so if we're in a situation where we couldn't spend all of it in 8, but we can spend it in 12, you can't then decide, oh, good, we're cutting off at 12. We're going to do our average FTEs during that 12-week period and base it on there. It's as of right now, it's 8 or 24, meaning that if you don't do 8, you got to do 24, and then his concerns could actually occur, the things he's concerned about could occur. The FTE count for the entire 24-week period would apply. Now, again, it's not necessarily what it is on December 31st. It's what it is at some point prior to December 31st. The one thing that's unclear a little bit, I'll just say, is there, when you're looking at whether you've returned your FTE counts to the required levels prior to December 31st, it's unclear whether the week you choose can also be within your covered period, if that makes sense. So you would think that if you're comparing what your FTE count is during your covered period and seeing if you cured any deficiencies, it kind of makes sense that you'd have to cure it in a period after the covered period ends, as opposed to just any week within it. But that's not exactly clear from the rules. But the concern that he has is an absolute concern. And what I would do there is, once you get to the end of 8 weeks, you can figure out what's my total forgiveness amount based on the information that I know to date. And then what do I think it's going to be at the end of 24 weeks? What's my best case, worst case, middle of the road scenario? And is it worth the risk of waiting 24 weeks, also knowing that I'm going to have most likely payments due, 6 months after the date I've received the loan, if I don't get the application for forgiveness in quickly and get approved for forgiveness. So that's a real concern. It's something to keep in mind. And I would just suggest that you look at both scenarios. The 8-week scenario, you should be able to do the math as soon as your 8 weeks is over. And with respect to the 24-week, make your best guess and see what the risk reward is for utilizing those two periods.
Okay. Carlisle says, my photography business ceased on March 13th when college sports halted. On May 1st, Carlisle received PPP, which only covered salaries for 2 employees for 10 weeks. With the increase of the period increasing up to 24 weeks, can I receive additional PPP funds to cover payroll after my current PPP funds run out mid-July?
No. So the total PPP loan is still capped at the 2.5 times the monthly payroll cost that it was always based on. There's no indication at this point that they're going to go back and kind of expand that amount for any particular scenarios. And there are scenarios where it would make sense to do that. And there is still some money left in the PPP. Theoretically, if the money that's out there that is not being utilized in the PPP remains out there, maybe they come up with some other potential option to distribute that. But I haven't heard any, back channel communications or grumblings about that being something that they're even considering at this point.
So maybe they'll be able to increase PPP funds, but right now there's nothing out there about that, correct?
Yeah, nothing out there. They would have to do a legislative act basically to account as a decision to help distribute the money that's still out there that was previously allocated to the PPP with the second round of funding. And I think that's not going to be very popular politically, as opposed to kind of bringing that money back in and not spending it in the first place. That's kind of my thought process. I haven't heard anything that's even being discussed.
Right. And then any other funding options to pay salaries? I know some local, like for instance, the Orange County IDA and Funding Corp had a small loan program to cover salaries. Some other counties are doing that as well. But are there any other funding options that you're aware of to pay salaries after the PPP runs out?
Well, the one that comes to mind is, loans under EIDL, economic injury disaster loans through the SBA. It's funny, some of you might be in this situation where the CARES Act, on top of the PPP also included this idea of emergency EIDL grants under the existing SBA programs for disaster loans, up to $10,000 of emergency grant money that doesn't have to be paid back. A lot of people applied for that and received that. In order to receive that, you had to apply for an EIDL loan, an EIDL loan. And then you got their grant. You don't have to pay it back. By the way, that whatever amount of money you got in grant that doesn't have to be replaced, that's deducted from your amount of forgiveness on the PPP. You've got to report that on your application for forgiveness. And if you got $10,000 of free money from an EIDL grant that doesn't have to be repaid, you're going to reduce your potential forgiveness amount by $10,000, basically saying, listen, you can't get forgiveness on money that you spent that wasn't your money anyway. It was free money. So they're kind of avoiding double forgiveness there.
Mm-hmm.
But people that apply for that EIDL grant back in, end of March, beginning of April, SBA has actually started approving EIDL loans. So you apply for the loan to get the grant, and then you didn't hear anything. Well, in the past couple of weeks, SBA has basically said, yep, by the way, your EIDL loan has been approved, and it's X amount of money, and here's the rules. So that's something that's out there. Now, there's no forgiveness associated with that, but it is an ability to get cash flow and get a loan that you have to repay to the SBA under that's the only big one that I'm aware of, other than, we talked about deferring employee payroll taxes. You can also, if you're a smaller employer, you can get a credit. Once the PPP money is gone and you meet some qualifications, you can get a credit potentially for employee retention credit, paying people to do work. That's something else you might want to consider to look at. But those are very fact specific. There's a lot of rules on that. So you'd want to discuss that with counsel to make sure you qualify and to make sure you're utilizing it the right way.
Gotcha. Joy asked, if we want to apply for the 8-week time, do we still have until 12/31 for FTE restoration?
Yeah, so everything indicates yes. The issue being is that if you need to cure a reduction, you can't assume that your FTE count's going to be completed at some point in the future when you submit your application. So if you're looking to avoid any reduction in forgiveness based on an FTE reduction, you've got to show that you've cured your FTE reduction or your salary reduction at the time by the time you submit your application in order to have that forgiveness amount cured. So, from a legal standpoint, yes, you've got till 12/31, but if you want to submit prior to that, then you have until you submit your application. What we don't know is whether there's going to be an opportunity to do second wave or multiple waves of forgiveness application. So here's a scenario. You're using the 8-week cover period. You took out, $500,000. Based on your FTE reduction, you're looking at, only having $300,000 capable of forgiveness, let's say by mid-July, but you want to apply for forgiveness so that when your payments become due, it's on the reduced loan amount, not the full $500,000. It would be nice if you were allowed to do that and at least get the amount is forgiven, 300 grand knocked off right away, and then at a later date submit an amended application showing, look, I've now cured my FTE reduction as of November. I cured it, so now I need the remaining money forgiven as well. There's no indication they're going to do that. That would make sense. I'm hopeful that's something they consider, because for anybody whose loan payments become due in 6 months, that kind of makes it impossible for them to take advantage of that 12/31 deadline if they're going to be paying large principal and interest payments on a loan that is largely going to be forgiven, but maybe not completely, if that makes sense.
It does. Alan asks if he's correct in assuming that FTE payroll costs are calculated using the employee's gross weekly wage.
In terms of, I guess in terms of if you're looking at what, in terms of what money, yes. So it's not their net, it's not their take home. It's whatever their gross pay is. That's included in payroll costs, and that's why it comes down to things like you can't count employee, elections or employee premium payments or 401k elected deferrals from an employee side, because you're already counting that money in the payroll costs. Gotcha. There was a lot of confusion about that, I think, back when this was first kind of put in, but all the guidance I've seen indicates that, yeah, we're talking about what they actually get paid what their actual wages are, as in what the employer is paying, whether it goes to someplace else, at the employee's election or because of taxes. That's not our issue. We're looking at that gross pay for the FT when determining that.
Perfect. Renee Karen asks, residential camps in New York are not able to open. Will their FTE count be excused?
Sorry, what was I missed the beginning part of that question?
Residential camps in New York are not able
Oh,
to.
residential camps. Yeah. So,
Yeah.
I mean, it depends. Theoretically, yes. If they qualify in terms of the one element that I talked about, that they couldn't return to pre-COVID levels due to guidance or regulations issued by OSHA, CDC, or HHS, Health and Human Services, which would seem likely there. It's a little interesting because a lot of these types of facilities can't open due to a local state rule, either local or statewide executive order guidance document. So what we don't know yet is what guidance or recommendations from HHS, CDC, or OSHA is going to be allowable to rely on, in terms of not opening. But if they fall within that category, then yes, they'd be excused from the FTE reduction because they could not return to levels. Now, if they don't have any payroll, then obviously they're not going to have any forgiveness. So you have to have some payroll in order to be forgiven, but at least it won't be reduced based on an FTE reduction if they fall within that category. That's an area that particular exemption is a newer one, and that's one we need more guidance on. So we'll kind of keep our eyes and ears open on that, and hopefully they'll provide us some real clear guidance on that particular topic.
Right. Terry asks, if you use the 8-week period, we might have covered this briefly, but if you use the 8-week period and exhausted the funds for the usable expenses, can you reapply for another forgivable loan?
No. So as of right now, you can only do it once. It's one of the certifications on the application for the loan that you haven't applied for and received a loan under this program before. It's a one-shot deal. Again, as of right now, theoretically that could change, but I don't think it's likely in the future. So we can't go through the process again, unfortunately.
Okay. Can gas for vehicles be used toward forgiveness? Yeah.
So generally speaking, if it's something that, yes, theoretically that falls within the covered utility under transportation. The big question there is going to be whether or not and then talk to your accountant, but whether or not it's something that would constitute a business utility expense under 1040 Schedule C. But I've seen some, smart accounting firms out there indicate that yes, that's something that if it's a business expense, then yes. So again, work with your accounting firms on the forms you need, and then you're going to need bank approval, obviously. But I have had some banks include those kinds of expenses.
Okay. And then Summer asks, what about ADP fees? Would payroll costs include ADP?
I don't think so, no. That wouldn't, the fee we pay to a processor, it doesn't fall within one of the categories of payroll costs, and it's not a local or state tax assessed on income either.
I see. For another question, if a part-time employee filed an unemployment claim for part of the period after they received the loan, will that be held against the forgiveness amount?
No, no. The fact that somebody's getting unemployment shouldn't matter. If they're receiving unemployment because they're getting reduced hours or reduced pay, then obviously the reduced hours or reduced pay would be taken into account when calculating for forgiveness. But just the fact that somebody receives unemployment after the covered period doesn't matter. The only thing, I guess, the one caveat there is that, if we had an FTE reduction during the covered period, the fact that we've got less employees after it will make it more difficult for us to cure, if we want to do that. But that in and of itself, there's nothing in the guidance that indicates, theoretically somebody that brought everyone back to full levels for the entire 8 weeks, spent all the money, and then as soon as the money was gone at the end of 8 weeks, let everyone go. Other than there's no way for them to cure any potential reduction during the covered period, there's no issue, there's no indication that there would be an issue with forgiveness there. There are companies that will be doing that. Brought everyone back for 8 weeks, paid them, and then once the money ran out, they had to lay people off again.
Right. So this is an interesting question. I know you can't double dip PPP in unemployment, but if I have no other options, can I apply for unemployment for myself once PPP funds run out?
Yeah, so that's, there's part of one of the biggest elements of the CARES Act was basically expanding unemployment insurance, including unemployment for people that otherwise wouldn't normally be eligible for it because they're self-employed or a sole proprietor or something like that. So that's certainly an option. People are doing that. That's something that they should consider doing. I recommend doing that. I recommend getting that process going, as quickly as possible, as long as you qualify for it. I will say that the delay in New York State has been greatly reduced due to the fact that people are kind of already registered for unemployment insurance, but there still might be a delay. We're also seeing an awful lot of fraudulent unemployment insurance claims. It's nothing to do with PPP, but if your company or one of your employees receives a notification from DOL or the Unemployment Insurance Appeals Board that they've requested unemployment insurance and they haven't, then that's fraudulent. It's happening in New York State, especially. It's happening in other states as well, but I know for a fact it's happening in New York. We've been dealing with it for about 3 weeks. So if that happens, report that as fraudulent to unemployment insurance. Have the employees do it. Don't do it on their behalf, but recommend that they do that because that's probably the case of identity theft and somebody is claiming unemployment insurance on their behalf. It's widespread right now.
I'm sure. So another question here. We received our loan on May 4th, but payroll is monthly at the end of the month. First payroll after disbursement is 5/31. The 8-week covered period from 5/4 to 6/29, which doesn't exactly line up with our payroll schedule. Will the bank SBA look at when our payroll company invoiced us in June or when payroll actually deposited salary to employees' account, which would be 6/30 of 2020?
So a monthly payroll is complicated because there was some guidance that indicated, that rule where I said that, listen, if it's earned during the covered period but paid afterwards, that it would be counted, even if it isn't paid till after the covered period. There was at some point a rule that only applied if your payroll was either, weekly or every 2 weeks. I'm not sure if they've still continued that rule. So that would be something to keep in mind. I can look at that and get back to you guys on that, and you can forward it along. So that under the previous rule, that person would be out of luck. They would look at when the electronic transfer actually was processed for the individual. The date. I will say that with respect to the ACH credit, if it's with a paycheck and that physical paycheck, it's on the day it's distributed. If it's an ACH credit, it's when the borrower originates it. So theoretically, if you originated it the day before and it fell within, then you could do that. But I think the bigger issue here is knowing whether or not you can pay somebody theoretically 30 days later for work performed during the covered period and whether that applies. And I'll look into that and get back to you on that.
Okay. Sandy asks if I can use all of the funds towards payroll or must a portion be used for other costs of doing business?
There's no requirement that it be used for anything other than payroll. It's just that payroll has to be at least 60% of the forgiveness amount. So it's totally okay to use 100% of the loans towards payroll. In fact, they prefer that you did that. 60% is a floor, not a ceiling. You can use as much of it as you want for payroll costs.
I see. Are federal unemployment and FICA, Social Security, Medicare taxes paid by employer considered covered payroll costs with the new guidance?
My understanding on that is that the employer portion of that, no. The employer portion is not. So it's only state or local taxes, the employer portion of that. The employee portion would be included because, again, it's gross wages, but not the employer portion based on the last guidance that I saw. They're looking at state and local, like unemployment insurance is an easy one, but not the employer portion of federal taxes.
I see. If you have a reduction due to employees resigning or choosing not to work, do you need to show proof of why there was a reduction in FTE?
So you're going to want, anytime you get a resignation or anytime you get somebody that doesn't return to work, you're going to want proof that that was not a layoff, that was a voluntary resignation. Now, obviously, this probably already happened. So if you don't have like proof, like a letter of resignation, let's say somebody just no call, no showed and never showed up again, just document it and make it clear that that's what happened in your own records, and that's probably the best you can do. To the extent you're trying to bring someone back that was furloughed, make sure you've got that offer in writing, and at the very least documented. If it was made over the phone, have documentation showing here's when the phone call was made, here's what was offered, he declined. But I would prefer to have it in actual writing, whether that's email or regular mail, letting them know that they're being offered, and then document the denial if at all possible.
Okay. This is a follow-up for one of the earlier questions about the filing for unemployment after PPP runs out. I've read that if I apply for unemployment for myself, my company will have the UI premiums go up over the next 3 years to cover the amount I receive in unemployment. Is that correct?
Yeah, I mean, so theoretically, absolutely. Your UI experience rating is based on how much UI your company uses. That's the case. There has been some, and there are some exceptions to that under the federal program. That for example, the $600 that comes from the feds, I don't believe will be, to the extent it's prior to July 31st, and you get the additional $600 assistance from the feds. That amount of money isn't built into your experience rating, only the state portion, is my understanding. But it will go up, but I don't think it would go up dollar for dollar, if that makes sense.
I see. Okay. This is also a follow-up to an earlier question. They didn't list their names, so I can't tell what question it was, but they say, we didn't reduce FTE or wages, and they're asking to determine if it's advisable to go with the 8-week covered period, which is their preference, to avoid paying a loan we hope will be mostly forgiven anyway. Does that ring a bell for you?
Yes. I mean, I guess if you don't need the 24 weeks to spend the money, then there's really no reason to utilize it. As long as you've got the money spent during the 8 weeks and you've maintained your FTE count during that period enough to avoid a reduction, then it makes sense to use the 8 weeks for many employers to avoid being in a situation where you actually have to start making payments on the full amount of the loan. That's kind of the takeaway. That's what most clients, if they're in that situation, a lot of them at this point are strongly considering using that 8-week period just to get it out the door and over with.
Right. Okay. And then last question, and it's perfect timing because we're 4 minutes left here. After my 8 weeks end this month and I submit forgiveness application, what happens if the rules are changed again to adjust the calculations for those of us who missed the 24-week option? I know this is an unfortunate, is this also quote unquote unfortunate? My frustration level is at an all-time high, which I'm sure everybody on this webinar understands, but do you have any guidance on that?
Yeah, absolutely. Based on our experience with things changing previously, there was never really an opportunity to go back and correct something after the fact. Well, there's one exception about the inclusion of partner income and payroll costs for general partnerships, where they originally said don't include that there, you've got to apply on your own. Then they said, oops, no, that isn't the case. So they allowed the people to go back and basically tack on a little extra money that they should have gotten in their original application, but didn't based on guidance. But there's no indication that I can't say that there's any reason to think that if something changes that it would apply to you, especially once that forgiveness application is approved and processed. There might be an avenue at some point to go back and correct it based on new guidance, but it's certainly not anything that I can guarantee or say with any kind of certainty.
Yeah. And I know we all, absolutely understand the frustration, and living it is different than talking about it. I know, but, if anything changes, of course, we will come back to Josh and have you go over any changes. But, this is certainly an evolving process, which we say every time we talk about this, but, we definitely understand the frustrations. And just for everybody who's on the call, who's on this webinar, if you have other questions or are seeking further guidance, you can always reach out to us at the IDA. We have a COVID button right on our page, the OCNYIDA.com. There's a COVID button. we have a team of professionals who can help you out or point you in the right direction or connect you with other professionals like Josh and other members of Harris Beach and accountants that we've kind of circled the wagons in a group of people who can help guide everyone through this process. So I want to thank you again, Josh, for your time. This has been, again, completely enlightening and definitely detailed and certainly helpful. And so we really, really appreciate that. And I appreciate everyone who spent their time with us on the webinar today. I know how frustrating this is, and I'm glad we're able to bring some answers to you. And like I said, don't forget that you're welcome to reach out to us, even outside of a webinar. There's contact us information on our page. This webinar will be available on that same COVID relief page, both the PowerPoint itself, as well as a video of the presentation, so you can go back and hear Josh's commentary again if you need to. And as a reminder, next week, June 25th at 10 o'clock, we'll have another informative session about financial management to help your business recover. We'll send registration information out by email, or you can check our website. Again, that's ocnyida.com for details. So Josh, thank you once again. We really appreciate your time and certainly your expertise in getting all this information to us. So thank you. And for everyone else, thank you for joining us. And we hope to see you next time, and feel free to reach out to us in the meantime. But until then, have a great day. Thanks, everybody.